You know, I really hate that old school mindset of waiting till you have 20% to put down on a house before you buy. I think that is a complete crock. In this video, I'm gonna explain to you why I personally believe that waiting to put down 20% to buy a home is not in your best interest. I'm also gonna explain to you why people were encouraging borrowers to have the 20% down. And then at the very end, I'm gonna do my best to kind of give you some examples to show you the difference if you were to wait versus not waiting. But before we jump into any of that, just a little bit of house cleaning. I'm Chris Nelson with Genstone Realty, the team lead of the Nelson Home Group, helping buyers and sellers here in the Montgomery County area. If you're new to this channel, do me a favor, let me know what you think of this video. And if you've been here before, welcome back. But do me a favor, consider subscribing, hit that thumbs up, and mash that bell so that you're notified of my future content. So first, let's start with why people were told that they should have 20% if they're going to buy a house. So if you're gonna buy a home and you are putting down less than 20%, there's something that's referred to as PMI, which is private mortgage insurance, or MIP, mortgage insurance premium. Now, both of these are additional fees that go into your loan, so you're gonna pay them in your monthly payment. And what this does is it lessens the liability that the lending institution has taken for giving you this loan, right? Basically, think about it like this. The people giving you the money is saying to you, wait a minute, you're not putting 20% down on this home. You have very little skin in the game, and we're the ones taking on all of the risk. And because that, we want to create some type of an insurance around this money that we're giving you. So you are actually paying towards, again, securing their investment. So if you are putting down more than 20%, your mortgage payment obviously would be lower because it doesn't have that mortgage insurance premium or that PMI. But to help you understand the difference between PMI and MIP, PMI is usually affiliated with conventional loans. PMI is calculated a little bit differently. It's actually a little bit more expensive than MIP, but PMI can also be removed at some point in the loan. If you actually get to a point where you have enough equity, 20% equity or more, you can call your servicer, and there's a process that you go through to have that insurance removed from your policy. Now, MIP, on the other hand, now this is actually for the life of the loan, and this is for government-backed loans, your Fannie Mae products. FHA is going to have that mortgage insurance premium attached to the loan for the life of the loan. So the only way you're going to get rid of it is if you were to refinance or sell the home and pay off that mortgage. Now, FHA usually caters towards first-time home buyers and buyers with a lower credit score. I've seen FHA approved buyers with a 580 credit score, where conventional is usually a little bit more difficult. You're probably in a 620 to 650 range when it comes to your credit score before they issue an approval. Now, with FHA, when you have MIP, it's actually calculated different than it is on PMI. Now, I know there's a lot of letters being thrown out, but just follow me. If you take an FHA loan, which is a loan, again, that will cater towards first-time home buyers or buyers with a lower credit score, there's two things to consider. There's upfront MIP. So at the time of settlement, in your closing costs, you're going to pay a portion of that mortgage insurance premium up front, and then every month there on out, a portion of your payment will include the actual annual mortgage insurance premium. So now let's put that into some numbers for you. Let's say you were buying a house and the loan amount for that purchase was $100,000. Well, MIP is calculated at 1.75%. So in that scenario, it would be $1,750 is what you would pay up front. After that, once you start making your mortgage payments, the MIP on an annual basis can fluctuate a little bit, but on average, it's right around 0.85% of the loan balance. So throughout the year, in that scenario, you would be paying out $850 over the course of the 12 payments. I know, again, it gets confusing, but just to give you an idea of how it all works. Now, on a conventional side, which is for the borrower who does potentially have a higher credit score, usually the PMI is just annual. Very few times will there be a need for the consumer to pay an upfront PMI with a conventional loan. But Ironically, the percentage rate on PMI could be higher than MIP. MIP, the floor is about 0.45 with the roof of just over 1%, where PMI can go as low as 1/10 of a percentage point all the way up to 2%. So depending on your credit and where you fall in that spectrum, you theoretically could pay more in your PMI than your mortgage insurance premium. So again, really the determining factor in those situations really is your credit. I always tell my clients that if you do qualify for a conventional loan, you usually want to consider that and not go the FHA route. Not that there's anything wrong with an FHA loan. I've closed many loans and put many buyers into new homes using an FHA product, but conventional usually is the cheaper way to go and usually have a little bit less turbulence when it comes to underwriting. But at the end of the day, is PMI right for you, right? That's the big question. Now, if you ask me, the short answer to that is yes. I think the bigger question is whether or not FHA or conventional financing is for you. That's really the big question in my opinion, because the way I see it, we need more people owning more homes. And whatever we need to do to get them in the door, so long as it's legal and it fits their budget, well, we need to consider those avenues. But let's create an example using a home purchase where a buyer was buying a home, and this time let's assume that the mortgage amount is $300,000. Okay, now this is where I want for you to think about if you were going to buy a house today and you don't have 20% down versus waiting to save that 20% on this $300,000 property. And let's just unpack that a little bit. So if you didn't have 20% saved, which in this scenario is about $60,000, let's say you qualified for FHA and you were able to buy this home with putting as little down as 3.5%. So instead of needing $60,000, you need just over $10,000 in this scenario to buy this property. That's roughly a difference of $50,000 that you would need. That $50,000 stands between you renting or owning a home. Okay, so now let's factor in the PMI versus not having the PMI. We already determined that a borrower is going to pay a certain percentage based off of the loan amount. So in this scenario, if the borrower has decent credit, the MIP is going to be somewhere around 0.85%, just less than 1% of the loan balance on an annual basis, which in this scenario comes out to be $212.50. So in your mortgage payment, $212.50 of that is going to be for your mortgage insurance premium. Now, keep in mind, you just saved $50,000 or you bought a house by putting the $10,500 down because you didn't have the $50,000, right? So now you own the home. Keep in mind, real estate appreciates. So let's assume that you decided to wait. You didn't buy, you had the $10,500, you decided to wait. Think about how long it takes the average consumer to save $50,000, especially in a world where everything is costing us more. Everywhere we turn, we hear inflation and interest rates. Properties are going to continue to appreciate, and it's going to take you some time to get from that $10,000 to that $50,000. So what do you think happens in that time frame? That same $300,000 property over, let's just say it takes you 5 years to save up that 20% down. Now you're ready to buy. You have the 20% down. Now you're able to save $212.50 in your mortgage payment because you saved up that money. But now that $300,000 property that you had the opportunity to buy 5 years ago has appreciated, and now that same home is worth just shy of $350,000. I could create the argument that you just lost $50,000 in equity. Technically you did because you decided not to purchase. And I could take it a step further. When you pay your mortgage, remember that $300,000 that you borrowed? 5 years later, that $300,000 through amortization drops, which means that the equity is even more. Your equity grows as you reduce your debt, and your equity grows as your property appreciates. So waiting 5, 6, 7, maybe 10 years in this situation to avoid PMI, to avoid that 20% at the end of the day just doesn't make sense. So if you're thinking about buying, first and foremost, download my buyer's guide. There's a link in the comments. But if you're thinking about buying a property, don't let that old school mentality of needing 20% keep you from entering the market as a buyer, because I personally think you're doing yourself a disservice. So do me a favor, let me know what you think. Have you been told not to buy because you don't have the 20%? Have you purchased and decided that it was in your best interest to buy even though you didn't have the 20%? Let me know. Let me know in the comments what you think. And as usual, I'm Chris Nelson with Genstone Realty. I hope this video was of value to you, and I hope to see you again right here very soon.